Hello viewers, welcome to my channel. I'm Hsham. Last video, 6 problems I have completed on capital budgeting. A very important topic of financial management. Very frequently asked questions from this topic in examination. So, the problems are based on the theory. That means a student must know what are the techniques of evaluating a capital budgeting proposal. So all the techniques are divided into 2 categories, that is traditional technique and modern technique. Traditional technique, undiscounted techniques are payback period method and average rate of return or accounting rate of return, ARR. The modern methods are the discounted methods where NPV, PI and IR. These are the different techniques. So before watching the problems, I suggest you be perfect about the concept. So if you have not watched, go to the playlist of my channel. Select the subject Financial Management for BBA. Select the topic, the theory of capital budgeting. Be perfect, then you can easily understand the problems. So if you want the perfect knowledge, watch all the videos from beginning till end. Don't join in between and don't skip in between. So in this video, 3 more problems I am going to explain you. Remember, every problem will have some new points. So you must remember, you must understand those new points. Now, before starting the 7th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Take the screenshot of the points, then I'll explain. Come on, see the 7th problem. No project is acceptable unless the yield 10%. This is a standard rate of return given by the management. So management says any project whose return is more than 10%, then only it is acceptable, otherwise it will be rejected. Cash inflows for a certain project along with the cash outflows are given below. So here year 0. Year 0 means beginning of the year. Then first year end, second, third, fourth, fifth. Cash outflows. Here cash outflows are given at 0 year and first year. Normally we will be given cash outflow at only 0 year only, at the beginning. But here 0 year as well as 1 year. So 2 times there is cash outflow. Then cash inflows are at the end of first year 20,000, second year 30,000, third year 60, fourth year 80 and fifth year 30,000. That means the life of the project is 5 years. Now, the salvage value at the end of the 5th year is 40,000. At the end of the life of the project, the scrap value realizable is 40,000. This is also a cash inflow. Calculate net present value, NPV. So, you know, the formula for NPV is PV of cash inflow minus PV of cash outflow. So we have to calculate what is the present value of cash inflows and present value of cash outflows. So first we calculate present value of cash outflow because 2 outflows are given at the beginning 0 year and at the end of the first year. So PV of cash outflow, year 0 year 1 year. At 0 year cash outflow 1,50,000 and first year end 30,000. Now it is saying that the discounting factor is 10% because no project is acceptable unless the yield is 10%. That means the cost of capital is 10%. The cut-off rate is 10%. So here PV factor is 10%. Remember, for 0 year, always the PV factor should be taken 1. The PV factor at beginning of the year always will be taken as 1. At the end of first year, at 10% discount rate, 0.909. So these table values you can get it from any textbook, and also I have uploaded in my description the PDF of PV values, present value and present value annuity value. Take a printout of those tables always. Without that it will be difficult to solve the problem. We can manually calculate on the calculator also, but it is time consuming. We have ready-made table values. So first year end 0.909. Now multiply 1,50,000 into 1 is 1,50,000. 30,000 into 0.909, 27,270. Take the total 177 270, that is the present value of cash outflow, right? Now we need present value of cash inflows. What is the life of the project? 5 years. So year 1 to 5. At the end of the 5th year, there is a salvage value, scrap value. That's why I have taken 2 times 5, 5. First 5 is the operating cash inflow. Every year, whatever we are getting cash inflow, that is the operating cash inflow. And again, I have written 5th year, this is salvage value. It is given in the problem. Now, cash inflows are 1st year, 2nd year, 3rd, 4th, 5th, and salvage value is 40,000. Now, present value of cash inflows at 10% discount rate. So, if you refer the table, 1st year 0.909, 2nd year 0.826, 0.751, 0.683, 0.621. So 5th year 0.621, again 5th year 0.621, right? Now multiply PV of cash inflow into PV factor, will get 18,180. Similarly, multiply all cash inflows with PV factor, you will get PV of cash inflow. Take the total of PV of cash inflow, 1,86,130. This is the present value of cash inflow. And present value of cash outflow, 177,270. Now the formula of NPV is PV of cash inflow minus PV of cash outflow. So here PV of cash inflow 186,130, PV of cash outflow 177,270. Subtract, you will get 8,860. That is a net present value. That's it. This is the end of problem number 7. Now problem number 8. See carefully problem number 8. It's a lengthy problem. A choice is to be made between 2 proposals which require initial investment of 50,000 each and are expected to generate net cash flows as below. That means mutually exclusive project. Any one of the project have to be accepted, either A or B. Now the life of the project is 5 years and the project A cash inflows are 25,000, 15,000, 10,000, 8,000, 6,000. And project B cash inflows are 10,000, 12,000, 18,000, 25,000, 4,000. The cost of capital of the company is 10%. This is the discounting factor we will use for calculating NPV. You are required to evaluate the project under payback period method, net present value method, and discounted payback period method. The discounting factors at 10% are: first year PV factors at 10%, first year 0.909, second year 0.826. Many times in the problem itself PV factors will be given. If it is given, then you are lucky. You don't require any table. Directly from the problem itself we can take the PV factors, right? So here PV factors are given. So 3 things it is asking you to calculate: PBP, NPV, and discounted PBP. That is the new part. And 2 projects are there, A and B. First of all, we calculate the normal payback period. For calculating the normal payback period, we have 2 methods. If the annual cash inflows are constant, we apply the formula. If the annual cash inflows are not constant, we calculate cumulative cash inflows. In our problem, the cash inflows are not constant. For project A, the cash inflows are 25,000, 15,000, 10,000, 8,000, 6,000. Year 1, 2, 3, 4, 5. So we calculate cumulative cash inflow. Cumulative. So first year 25,000 same. 25,000 plus 15,000, 40,000. 40 plus 10, 50,000. 50 plus 8, 58. 58 plus 6, 64,000. These are the cumulative cash inflows. Now how to find out the PBP? Initial investment is 50,000. Now we have to locate in which year our cumulative cash inflow is 50,000. That year is the PBP, payback period. Now if you observe here, 50,000 is the cumulative cash inflow against which year? 3rd year. The PBP is 3 years. That's it, so easy. Now project B. We have calculated for project A, 3 years. For project B, 1, 2, 3, 4, 5 years. Cash inflows are given in the problem. Cumulative cash inflow, 10,000 same. 10,000 plus 12,000, 22. 22 plus 18, 40. 40 plus 25, 65. 65 plus 4, 69. Now locate 50,000. The initial investment is 50,000. Look at 50,000 in cumulative. We don't have 50,000. In projective directly we got 50,000. Here it is 40,000 then 65,000. So it is 40 above 40,000 and below 65,000. So our PBP lies between third year and fourth year. Between third year and fourth year. The actual PBP, how to find out? Here the procedure. Initial investment 50,000. Rupees 40,000 is recovered up to the end of 3 years. Up to the end of 3 years we got 40,000. Still how much we require? 10,000 more because we need 50,000. 40,000 we recover third year. So 10,000 more we have to recover in fourth year. And what is the cash inflow of fourth year? 25,000. So fourth year cash inflow is 25,000 but we need only 10,000. So 10,000 is the amount to be recovered in the fourth year and cash inflow in the fourth year is 25,000. So 10,000 we want out of 25,000. So 10 divided by 25 you will get 0.4. So 3 plus 0.4. So 3.4 years. That is the payback period. So we have calculated the PBP for A project as well as B project. For A project we got 3 years. For B project we got 3.4 years. So which project is acceptable according to PBP? A project. Whichever project has a lower PBP, that project is preferable. That is beneficial. So A project has a lower PBP, that is better from PBP point of view. Now we have to calculate the NPV, net present value. PV of cash inflow minus PV of cash outflow. Outflow is given in the problem 50,000. No need to calculate. We have to calculate PV of cash inflows. So year 1, 2, 3, 4, 5. PV factors 0.909826 given in the problem. Now I made two broad columns. Instead of calculating separately, in one table itself I am calculating both NPV for both the projects. So two broad columns, A column, B column. Two sub columns, CI, cash inflow, PV of cash inflow. Again cash inflow for B project, PV of cash inflow for B project. In one table itself I am calculating PV of cash inflow for both the projects. Now multiply 25,000 into 0.909, 22,725. 15,000 into 0.826, 12,390. Like this you multiply this PV factors with cash inflow, then total 51,815. That is the PV of cash inflow of project A. Similarly, we calculate PV of cash inflow of project B. These are the cash inflows 10,000, 12,000, 18,000. Multiply 10,000 into 0.909. These PV factors are applicable to both the projects. So we have to multiply PV factors with cash inflows. So 0.909 into 10,000, 9,090. 0.826 into 12,000, you will get 9912. The total is 52,079. We got the PV of cash inflow of A project as well as B project. Now we have to calculate the NPV, net present value. So PV of cash inflow of first A project 51,815, B project 52,079. And the present value of cash outflow, the initial investment is same 50,000. 50,000 for both the project. Subtract 1,815 and here 2,079. So we got the NPV. From NPV point of view, which project is preferable? Whichever project has a higher NPV. जितना ज़्यादा NPV रहेगा उतना better होगा. So here B project is more profitable. So after calculating, you have to give a note. According to PBP criteria, A project was better because A project is having lower PBP. And according to NPV criteria, B project is better because B project is having a higher NPV. Right? Now, discounted PBP. First time we are going to calculate discounted PBP. Two types of PBP are there, normal PBP and discounted. In normal PVP, we will not consider the time value of money. Discounting will not be done in normal PVP. Now discounted PVP will take into account the time value of money. So PV factors will take, multiply the PV factors with cash inflow to get PV of cash inflow. After getting PV of cash inflow, make it cumulative. Make it cumulative PV of cash inflow. Here only cumulative cash inflow, but here cumulative PV of cash inflow. That is the new point. See here. Discounted PVP, first of all, project A. Project A 5 years life, and cash inflows are already given 25, 15, 10, 8, 6, and PV factors are 0.909826. Same thing I have copied. When you multiply cash inflow with PV factors, already we got it here 22,725. Right? Similarly, 12,390, 7,510, and 5,464, 3,726. Up to here it is clear. Now we have to make the cumulative. The first year PV of cash inflow will be same cumulative 22,725, 22,725. 22,725 plus 12,390 will get 35,115. 35,115 plus 7,510 will get 42,625. Plus 5,464, 48,089. Plus 3,726, 51,850. Now you see, the total of PV of cash inflow must be same as the cumulative of the last year. Here 51,815, here also 51,850. Cumulative. Now our initial investment is 50,000. Now look at 50,000 in which year? The cumulative PV of cash inflow is 50,000. But we don't have 50,000 here. We have 48,000, then 51,000. We need 50,000. So our PVP lies between 4th year and 5th year. Between 4th year and 5th year. So amount recovered up to the end of 4th year, 48,089. Amount recovered at the end of 4th year. Then amount to be recovered in the 5th year. So 50,000 minus 48,089, 1,911. This is the amount to be recovered in the 5th year. And what is the PV of cash inflow of the 5th year? 3,726. So out of 3,726, we need 1,911. So 1,911 divided by 3,726. This is the 5th year cash inflow. So it will become 0.51. So 4 plus 0.5. It comes to 4.51 years. This is the discounted PVP of project A. Similar calculations we have to make for project B also. Here we have taken cash inflows, we have taken PV factors, we have taken PV of cash inflow. Here we have already calculated 0.909, 9912, 13, 13,518, 17,075 and 2,484. Already we have multiplied here. Now we need cumulative PV of cash inflow. So 9090 plus 9912, 19,002 plus 13,518, 32,520 plus 17,075, 49,595 plus 2,484, 52,079. The last year's cumulative cash inflow will be same as the total PV of cash inflow. Here you can see total PV of cash inflow 52,079. Here also 52,079. Now, our initial investment is 50,000. Look at 50,000 in cumulative. Again, we don't have exact 50,000. We have less than 50,000 or more than 50,000. 4th year end 49,595. Then 5th year end 52,079. So here amount recovered up to the end of 4th year is 49,595. Amount to be recovered in 5th year. So 50,000 minus 49,595. 405 rupees we have to recover in 5th year. So what is the cash inflow in the 5th year? 2,484 PV of cash inflow. The PV of cash inflow in the 5th year is 2,484. Out of 2,484 we need 405. So 405 divided by 2,484, you will get 0.16. So 4 plus 0.16, 4.16 years. So what is the criteria? The lower the discounted PVP, that will be better. So which one is lower? 4.51 or 4.16? 4.16 is favorable. So according to discounted PVP method, project B is beneficial, is preferable. That's it. So in 8th problem, I have explained you about PBP, NPV and discounted PBP. And you have to give the conclusion also, which project is preferable. Now, see the 9th problem. Calculate the IRR. First time we are going to calculate IRR. So far we have done PBP, ARR, NPV and discounted PBP. Now IRR, internal rate of return of the project, which requires an outlay of 6,000. Outlay means initial investment 6,000 and is expected to generate cash inflows of 2,000 per annum constant. The project is having a life of 5 years. That means initial investment 6,000, every year cash inflow is 2,000 for a period of 5 years. Now, advise management if the company's cost of capital is 15%. That means the cutoff rate is 15%. Management says any project whose IRR is more than 15% is acceptable. If the actual IRR happens to be less than 15%, reject the project. Like that we have to take the decision. But before that we have to calculate the IRR. How to calculate? First time. See the formula I am going to explain you. Calculation of IRR. The annual cash inflows are constant. Whenever annual cash inflows are constant, calculate the actual PBP. PBP, what is the formula? Initial investment divided by constant annual cash inflow. So this actual PBP will calculate only when the annual cash inflows are constant. If it is not constant, in the next problem I'll explain you what is the procedure. But time being, remember, if the annual cash inflows are constant, actual PBP. Initial investment 6,000 and constant cash inflow 2,000. So 6,000 by 2,000 is 3. 3 is the actual PBP, right? Now you have to locate the PV of annuity table. The PV of annuity table already I have uploaded in the description. You have to take a printout and keep ready. Without referring this annuity table, you cannot be able to calculate IRR. So in any textbook also you can find the PV of annuity tables, and better you take a printout from my description, download it and take a printout, right? In examination you can carry it. Now locate two discount factors in PV of annuity table against the life of the project. What is the life of the project? 5 years. In the line 5, you search two values. One value should be lower than 3 and the other value should be greater than 3. लाइन से देखते जाइए आप, जो पीवी ऑफ एन्युटी टेबल है, रो में 5 इयर्स, रो में 5 इयर्स की लाइन में देखते जाइए, एक वैल्यू 3 से ज्यादा, एक वैल्यू 3 से कम लेना है. तो यू विल फाइंड एट 19% 3.058, 19% के कॉलम में यू विल फाइंड 3.098, दैट इज ग्रेटर देन 3, और 20% इट इज 2.991, दिस इज लेस देन 3. So one value is more than 3, the other value is greater than 3. At what rate? 19% and 20%. So our actual IRR lies between 19% and 20%. So how to calculate the actual IRR? This is the formula. IRR is equal to RL plus DFL minus PB divided by DFL minus DFH into delta R. Now I'll elaborate what is this RL. RL is equal to lower rate. Two rates we have, 19% and 20%, which is the lower rate 19%. So RL is equal to 19% here. Then DFL, DF, discount factor at lower rate. These are the discount factors. Discount factor at lower rate is 3.058. So DFL 3.0. DFH, discount factor at higher rate is 20%, 2.991. And delta R means the difference between the two rates. The two rates are 20 and 19. The difference 20 minus 19 is 1. That's it. Now substitute the values. RL is 19, and DFL is 3.058, PB, payback period, is 3, here it is, divided by DFL minus DFH, 3.058 minus 2.991 into 1. So if you subtract 3.058 minus 3, 0.058. Similarly, denominator if you subtract, you will get 0.067. Now divide 0.058 divided by 0.067, you will get 0.87. So 19 plus 0.87, you will get 19.87. It is approximately equal to 20%. That means the actual IRR of the project is 20%, whereas the cutoff rate, cost of capital given in the problem is 15%. So is the project viable or not? Yes, of course. So after completing this, you should give the conclusion. The project should be accepted since the actual IRR is more than the cost of capital. That's it. So in this problem, in this video, I have explained you 3 problems, 7, 8 and 9. Different topics are there. So don't casually watch the video. With full interest, with full concentration, if you watch my videos, definitely you can enjoy learning the subject financial management. You will get a lot of confidence from my explanation because each and everything crystal clear I am explaining, putting my 100% effort for your benefit. So if you are satisfied, give a like to the video. Share my channel in your groups, in your friends, so that more students can watch the video. And subscribe my channel if you have not yet subscribed. Inshallah, we'll continue the next problem in the next video.